Before we begin, please note that I am not a licensed insurance agent or financial advisor. This presentation is for informational and educational purposes only and does not constitute financial or legal advice. The world of insurance is complex and constantly changing. Always consult with a qualified and licensed professional in your state to discuss your individual needs and circumstances before making any policy decisions. You are being ripped off by your car insurance company. That's not a guess, it's a statistical near certainty. And the worst part is the policy you're overpaying for is likely a ticking time bomb, set to financially obliterate you the moment you actually need it. Think about this. A young woman, let's call her Maria, was driving home from her nursing shift in Houston. She was doing everything right. Driving the speed limit on I-610, paying her insurance bill on time every month for 6 years straight. Suddenly, a car barrels through a red light and T-bones her. The crash was violent, totaling her car and sending her to the hospital with a fractured collarbone and severe whiplash. Lying in the hospital bed, she had one small comfort. At least I have good insurance. That comfort shattered a week later. She got a call. The driver who hit her? He had the bare minimum insurance required by the state of Texas. It wouldn't even cover half of her medical bills, let alone her destroyed car or the weeks of lost wages. Then came the second gut punch. Maria discovered her own policy, the one she'd faithfully paid for, didn't have the specific coverage needed to protect her from a driver exactly like this. She was a good driver. She was the victim. And yet, she was on the hook for over $50,000 in debt. Her life was turned upside down, not by the crash, but by a few lines of fine print she never understood. Maria's story isn't a freak accident. It's a business model. It happens every single day to thousands of Texans. And the reason it happens is that the auto insurance industry is built on a foundation of confusion. They use intimidating jargon, confusing numbers, and policies that are hundreds of pages long, all designed to make you feel overwhelmed, to make you just sign on the dotted line and hope for the best. Well, today that stops. This is not going to be another boring lecture filled with industry terms. This is your armor. This is your playbook. Over the next several parts of this guide, we are going to systematically dismantle every single piece of a Texas auto insurance policy. I will give you the exact knowledge the insurance companies use against you so you can use it for yourself. You will learn how to spot the traps, how to identify the coverage you actually need, and how to get it without overpaying. By the end of this, you won't just understand your policy. You will master it. You will be in control. So let's start with the absolute bedrock of every single auto insurance policy in the state of Texas: liability coverage. If you remember nothing else, remember this: liability coverage is not for you. It never pays you a single dime. Liability coverage pays for the damage you do to other people and their stuff. If you cause an accident, this is the part of your policy that pays for the other person's medical bills, their car repairs, their pain and suffering. It's your financial shield that protects your personal assets, your savings, your home, your future income, from being taken in a lawsuit. In Texas, and in most of the country, liability coverage is broken down into 3 numbers. You've seen them on your policy documents. It looks something like 30/60/25 or 50/100/50. It's confusing, right? It's meant to be. But let's break it down. It's actually simple. The first 2 numbers are for bodily injury liability. The last number is for property damage liability. Let's use the numbers 30/60/25 as our example. The first number, 30, stands for $30,000. This is the maximum amount your insurance company will pay for any one person's medical bills in an accident that you cause. If you hit someone and their hospital stay costs $28,000, you're covered. But if it costs $40,000, your insurance pays the first $30,000, and you are personally on the hook for the remaining $10,000. The second number, 60, stands for $60,000. This is the maximum total amount your insurance will pay for all injuries in a single accident you cause. Let's say you run a stop sign and hit a minivan with 3 people inside. Person A has $25,000 in medical bills. Person B has $20,000. Person C has $20,000. What's the total? $65,000. Your policy has a cap of $60,000 for everyone involved. So, your insurance pays out $60,000, and you are now personally responsible for that extra $5,000. And notice, the first limit still applies. No single one of those people can get more than $30,000. The third number, 25, stands for $25,000. This is the maximum amount your insurance will pay for all property damage you cause in an accident. This is usually the other person's car, but it could also be a mailbox, a storefront, or a city light pole. If you rear-end a 10-year-old Honda Civic, $25,000 is probably enough. But what if you rear-end a brand new Ford F-150, or a Tesla, or a BMW? The average cost of a new car in America is now over $48,000. If you total one, your $25,000 in coverage is going to run out before the tow truck even leaves the scene. You are personally liable for the rest. So why did I pick the numbers 30/60/25? Because that is the absolute legal minimum amount of liability coverage you are required to have to legally drive a car in the state of Texas. And right now, I want you to pause and think about the sheer terrifying inadequacy of those numbers. $30,000 for a single person's medical bills. Have you been to an emergency room lately? An ambulance ride alone can be thousands of dollars. A single night in a hospital, a few x-rays, a surgery for a broken bone, that can easily exceed $30,000. We're not talking about a catastrophic, life-altering injury. We're talking about a common, everyday fender-bender injury. And $25,000 for property damage? Look around you on the highway during your next commute. Count how many cars you see that cost more than $25,000. It's almost all of them. Pickups, SUVs, luxury sedans, electric vehicles. Hitting any one of them could be a financial disaster if you only have state minimum coverage. This is what I call the state minimum trap. Millions of Texans fall into it because they think, if it's the legal requirement, it must be enough, right? Wrong. It is a catastrophic failure waiting to happen. The state minimum isn't designed to protect you. It's designed to be the lowest possible barrier to entry for driving. It's a token amount that provides a false sense of security. When you are underinsured with state minimum coverage, and you cause an accident that exceeds those limits, the story doesn't end with you just getting a bill in the mail. The other driver's insurance company will pay to fix their client's car and cover their medical bills. And then their lawyers will come after you to get that money back. It's called subrogation, and they are relentless. They will sue you. They will get a judgment against you. And with that judgment, they can garnish your wages, taking money directly from your paycheck before you even see it. They can put a lien on your property, including your house. They can freeze your bank accounts. This one simple mistake, choosing the cheapest legal option, can plunge you into a decade or more of financial ruin, all because of one bad turn, one moment of distraction. So what's the answer? The obvious first step is to raise your liability limits. And you should. Significantly. Most financial experts recommend a bare minimum of 100/300/100. That's $100,000 for one person's injuries, $300,000 total for all injuries, and $100,000 for property damage. And here's the secret the insurance companies don't advertise. The price difference between the disastrous state minimum and a truly protective level of coverage is often shockingly small. We're talking maybe $10 to $20 a month. The price of a few cups of coffee for a shield that can protect you from a $100,000 lawsuit. But raising your liability limits is only step one. It's the defense. It protects you when you are at fault. But what about the Maria story? What happens when you are the victim? What happens when you get hit by one of the millions of Texas drivers who are either completely uninsured or are driving around with that worthless state minimum policy? Your high liability limits will do absolutely nothing for you in that situation. Because remember, liability pays the other guy. To protect yourself from them, you need a different kind of coverage entirely. A coverage that is often sold as an add-on, but is, in my opinion, the single most important part of your entire policy. It's the key that unlocks true protection, and it's what we are going to break down piece by piece in the very next part. This miracle coverage is called Uninsured and Underinsured Motorist Protection. And it's not just a line item on your policy. It's a financial life raft in a sea of irresponsible drivers. To understand why it's so critical, I want you to imagine something. Picture yourself driving home on a Friday afternoon. You're on the I-35, maybe heading out of Dallas or Austin. The sun's in your eyes a little, but the weekend is close. You're obeying the speed limit, you're not on your phone, you're doing everything right. Suddenly, a beat-up sedan in the next lane swerves violently, trying to make a last-second exit. They don't see you. The screech of tires is the only warning before the sickening crunch of metal on metal. Your world spins. Airbags explode like a cannon blast, filling the car with a chalky chemical smoke. When everything stops, you're dazed. Your arm is screaming in pain, your head is throbbing. The side of your brand new SUV, the one you just bought last month, is now a crumpled work of abstract art. The paramedics arrive, then the police. You're taken to the hospital. The diagnosis isn't great. A broken arm, a concussion, and severe whiplash. The other driver? They walked away with a few scratches. But here's the real gut punch. As the police officer is taking your statement in the emergency room, he tells you the other driver had no insurance. Not a single shred. He let it lapse 6 months ago. He has no assets, no savings, and works a cash-only job. He can't pay. Suddenly, you're facing a mountain of problems. Your $50,000 SUV is likely totaled. You have an ambulance bill, an emergency room bill, and you're going to need surgery on your arm, followed by months of physical therapy. You can't work because of the concussion and the injury, so you're losing income every single day. The total cost is easily going to climb past $100,000. And the person who caused all of it, he has nothing. So who pays? This isn't a scare tactic. This exact scenario plays out every single day on Texas roads. Texas has one of the highest rates of uninsured drivers in the entire country. The latest statistics show that roughly 1 in 8 Texas drivers on the road with you right now has zero insurance. Think about that. On your daily commute, you will pass dozens, if not hundreds, of drivers who have no ability to pay for the damage they might cause. This is where Uninsured Motorist Coverage, or UM, becomes your hero. It's insurance you buy for yourself to protect you from the uninsured. It's broken down into 2 main parts. First, there's Uninsured Motorist Bodily Injury, or UMBI. This is the part that pays for you and your passengers' medical expenses when you're hit by an uninsured driver. It covers your hospital bills, your surgery, the physical therapy. It also covers lost wages. If you're a contractor who can't work for 3 months, it replaces that lost income. And critically, it also covers pain and suffering compensation for the physical pain and emotional distress the accident caused you. Without UMBI, in that scenario we just imagined, you would be on your own. You'd have to sue the other driver personally, but as the saying goes, you can't get blood from a stone. If he has no money, a court judgment is just a worthless piece of paper. Your UMBI coverage steps in and acts as the insurance the other driver should have had. Second, there's Uninsured Motorist Property Damage, or UMPD. This part is designed to pay for the repairs to your car, up to a limit of $25,000 in Texas. It also comes with a mandatory, state-set deductible of $250. Now, here is a crucial Texas-specific detail you need to know. You cannot carry both UMPD and collision coverage on the same vehicle. You have to choose one or the other. And 9 times out of 10, collision coverage is the far superior choice. Collision covers damage to your car regardless of who is at fault, and it covers the full value of your car, not just a $25,000 limit. We'll dive deep into collision coverage in the next part, but for now just know that if you have collision, you don't need and can't get UMPD. So that's the uninsured part. But what about the name of the coverage? Uninsured and underinsured. The second half is just as important. Let's rewind our story a little. Same accident, same devastating injuries. But this time the police officer tells you the other driver does have insurance. For a second you feel a wave of relief. But then the officer tells you they have a state minimum policy. In Texas, the minimum amount of bodily injury liability insurance a person is legally required to carry is just $30,000 per person. Your medical bills alone are over $100,000. The other driver's insurance company will write you a check for their policy limit, $30,000, and then they wash their hands of the situation. They have fulfilled their legal obligation. You are still left with $70,000 in medical bills, not to mention all your lost wages and pain and suffering. You are severely underinsured. This is where Underinsured Motorist Coverage, or UIM, saves the day. It's designed to fill the gap. Once the at-fault driver's insurance pays out its limit, your UIM coverage kicks in to cover the rest, all the way up to the limit you selected on your own policy. So if you had $100,000 in UIM coverage, it would pay that remaining $70,000 in bills. It bridges the canyon between the other driver's pathetic coverage and your actual damages. So how much of this coverage should you actually have? This is the single most important piece of advice I can give you. You should purchase uninsured/underinsured motorist limits that are identical to your bodily injury liability limits. Let me repeat that. Your UM/UIM limits should match your liability limits. Think about the logic here. Your liability limits are the amount of coverage you buy to protect a stranger you might accidentally injure. If you choose, say, $100,000 in liability coverage, you are saying, I believe a person's medical bills, lost wages, and suffering could be worth at least $100,000, and I want to be responsible for that. So my question to you is this. Why on earth would you buy less protection for yourself and your own family than you would for a complete stranger? Why would you value your own well-being less than someone you've never met? It makes no sense. If you are willing to protect a stranger with a $100,000 policy, you should demand no less for yourself. Match your limits. If you have 250/500 liability, get 250/500 UM/UIM. It is the only rational choice. And the best part? Surprisingly affordable. For the monumental protection it offers, UM/UIM is often one of the cheaper components of your policy. We're talking about a few extra dollars a month to get hundreds of thousands of dollars in protection against a very real, very frequent threat on Texas roads. Now, one final point of clarification for Texas drivers. You may have heard of something called stacking in other states. That's where if you have 3 cars on your policy, you can stack the UM/UIM limits for all 3 cars to apply to a single accident. Texas is a non-stacking state. You cannot do this. The limits you see listed on your policy for one vehicle are the absolute maximum you will get, regardless of how many cars you insure. This makes it even more vital to choose high enough limits from the start. Rejecting this coverage, which you have to do in writing in Texas, is, in my opinion, one of the most financially reckless decisions a person can make. You are essentially betting that you will never be the victim of a serious accident caused by someone with little or no insurance. Given that there are more than 3 million uninsured drivers in Texas alone, that is a terrible bet to make. So you've now protected yourself and your passengers from the financial fallout of an irresponsible driver. But what about all the other risks? What about a massive Texas hailstorm that makes your car look like a golf ball? What about a deer that jumps out on a farm-to-market road? Or what about an accident that is, honestly, your own fault? Those situations require a completely different kind of shield. It's the combination of coverages that people generically call full coverage. But the term itself is dangerously misleading. To truly protect the investment you've made in your vehicle, you need to understand the 2 pillars of that protection, and we will break down exactly what they cover, and more importantly, what they don't, in the very next part. These 2 pillars are collision coverage and comprehensive coverage. And let me be crystal clear. These have nothing to do with the other driver. They have nothing to do with the person you might hit. These are all about one thing: fixing or replacing your car. This is the part of the policy that protects your investment, your asset, the thousands of dollars you spent on that vehicle sitting in your driveway. Let's start with collision. The name is pretty straightforward, but the details are what trip people up. Collision coverage pays to repair or replace your car if it's damaged in a collision with another object, or if it overturns. The key word there is object. Most people think this means another car, and it does. If you rear-end someone, your liability coverage pays for their car, and your collision coverage pays for yours. But it's so much more than that. Let's say you're driving on a dark Texas road, you swerve to miss an armadillo and hit a fence post. Collision covers that. You back out of a tight parking spot at H-E-B and scrape your door on a concrete pillar. Collision covers that. You hit a massive car-swallowing pothole on I-35 that causes you to lose control and roll into a ditch. Collision covers that too. It's your protection against damage caused by, well, colliding with things. Now, here's the most important part of collision coverage you need to understand: the deductible. Your deductible is the amount of money you have to pay out of pocket for a repair before your insurance company pays a single dime. Think of it like a copay at the doctor's office. You pay your part first, then the insurance kicks in for the rest. Deductibles typically range from $250 to $2,500, with the most common being $500 or $1,000. Let's make this real. Imagine you have a $1,000 collision deductible. You get into an accident that causes $5,000 worth of damage to your car. You will pay the body shop the first $1,000. Your insurance company will then pay the remaining $4,000. If the damage is only $800, you're paying for the entire repair yourself because it's less than your deductible. The insurance company pays nothing. This is a trade-off. A higher deductible, say $2,000, means you're taking on more financial risk yourself. Because of that, the insurance company will reward you with a lower premium. You pay less every month. A lower deductible, like $250, means the insurance company is taking on more risk, so your premium will be higher. Choosing your deductible is a personal financial decision. You have to ask yourself, If I get in an accident tomorrow, what amount of money can I comfortably write a check for without causing a financial crisis in my life? That's your deductible. So, who needs collision coverage? By Texas law, no one. But if you have a loan on your car or you're leasing it, your lender will absolutely 100% require you to have it. Why? Because until you pay it off, they technically own the car. They have a financial interest to protect, and they are not going to let you drive around in their asset without insurance to fix it if you wreck it. If you own your car outright, the decision is yours. The general rule of thumb is to consider the car's value. Insurance companies pay what's called actual cash value, or ACV. That's the value of your car right before the crash, not what you paid for it. If you're driving a 15-year-old car that's only worth $2,000, and you have a $1,000 deductible, you might be paying hundreds of dollars a year in premiums for a maximum potential payout of only $1,000. In that case, you might decide to drop collision coverage and bank the savings for a future repair. That brings us to the second pillar, comprehensive coverage. This is often called other than collision coverage, which is a perfect description. It covers damage to your car from almost everything except a collision. This is your protection against the random, unpredictable chaos of the world. Think of it as the acts of God and acts of man policy. What does that mean? It means if a Texas hailstorm turns your brand new F-150 into a dimpled piece of modern art, comprehensive coverage pays for it. It means if you're parked downtown and a thief smashes your window and steals your stereo, comprehensive covers the broken window. If your car is stolen from your driveway and never seen again, comprehensive pays to replace it. It covers fire, floods from a hurricane rolling in off the Gulf, vandalism, like someone keying your paint, and falling objects like a tree branch crashing onto your roof during a thunderstorm. And here's a big one that confuses a lot of Texans: hitting an animal. If you swerve to miss a deer and hit a tree, that's a collision claim. But if you hit the deer directly, that is a comprehensive claim. It's a strange distinction, but an important one. Just like collision, comprehensive coverage has its own deductible. And here's a pro tip: your comprehensive deductible does not have to be the same as your collision deductible, because comprehensive claims are often less severe. Think a cracked windshield versus a crumpled front end. Many people choose a lower deductible for comprehensive, like $250 or $500, while keeping a higher $1,000 deductible for collision. This can be a smart way to balance your monthly costs with your potential out-of-pocket risk for different types of damage. And just like collision, comprehensive coverage is not required by the state, but it will be required by your lender if you have a loan or a lease. Now let's talk about the biggest lie in the auto insurance industry. It's a phrase you've heard 1,000 times. You've probably even said it yourself. The phrase is full coverage. When you call an agent and ask for full coverage, what you're typically getting is a policy that combines the state-required liability coverage with these two pillars we just discussed, collision and comprehensive. And for many people, that sounds perfect. Sounds complete. Sounds full. But it is a dangerously misleading marketing term. There is no such thing as a full coverage policy. It's just industry slang. Believing you have full coverage can lead you to a devastating financial shock after an accident, because there are massive, gaping holes in that standard package. Think about it. You get into a serious accident. Your car is in the shop for 3 weeks. Your full coverage policy fixed your car, great. But how are you getting to work? How are you taking your kids to school? Does your policy pay for a rental car? Not unless you added rental reimbursement coverage. It's not included. What if you're injured? Your full coverage policy has liability to pay for the other person's injuries if you're at fault. But what about your own medical bills? What about your lost wages from being unable to work? Standard full coverage doesn't touch that. That requires a completely separate coverage. And here's the most terrifying scenario of all. What if the person who hits you is one of the millions of drivers in Texas who has no insurance at all? Or they have the bare minimum coverage, which is quickly exhausted by the cost of a modern hospital visit. Their insurance isn't going to pay you. You can try to sue them, but you can't get blood from a stone. So who pays for your medical bills, your pain and suffering, your totaled car? Your so-called full coverage policy? Absolutely not. So if full coverage isn't really full, what are the other critical pieces you're missing? There are 3 specific add-ons that can save you from financial ruin after an accident, and one of them is arguably the most important coverage you can buy in Texas. We'll reveal what they are next. Okay, let's pull back the curtain on the 3 types of coverage that separate a decent policy from one that can genuinely save your life, financially speaking. These aren't just obscure add-ons. They are the essential pillars that support you when things go horribly wrong. The first one deals with the most expensive thing you probably own, besides your house, your car itself. This is collision and comprehensive coverage. Now, a lot of people get these confused or think they're the same thing. They're not, but they are almost always sold together as a package, often called full coverage. Let's be crystal clear. The state minimum liability insurance we talked about before does absolutely nothing for your own car. Zero. If you cause an accident, it pays for the other person's car, not yours. If a tree falls on your car, it does nothing. If your truck gets stolen from the HEB parking lot, liability insurance just shrugs. Your car is your problem. That's where collision and comprehensive come in. Collision coverage is exactly what it sounds like. It pays to repair or replace your car if it's damaged in a collision with another object. Another car, a pole, a guardrail, you name it. It doesn't matter who was at fault. If you swerve to miss a deer and hit a fence, collision has your back. If someone dings your door in a parking lot and drives off, collision is what you use. Comprehensive coverage is the everything else policy. It's for all the non-collision chaos that life, and especially Texas weather, can throw at you. A hailstorm shatters your windshield and turns your hood into a golf ball? That's comprehensive. Your car is stolen? Comprehensive. A flood sweeps it away? Comprehensive. Fire, vandalism, hitting an animal on a dark farm-to-market road. All of this falls under comprehensive. Think of it this way. You just bought a brand new Ford F-150. You're making payments on it. To save $100 a month, you decide to skip full coverage and just get liability. 2 months later, one of those legendary Texas thunderstorms rolls through. You wake up to find your beautiful new truck has been hammered by baseball-sized hail. It's a total loss. The bank still wants its $60,000, but your insurance company won't give you a dime because you didn't have comprehensive. You are now stuck paying for a giant dented lawn ornament for the next 5 years. If you have a loan on your car, the lender will almost certainly require you to have both collision and comprehensive. But even if you own your car outright, if you can't afford to just go out and buy a new one tomorrow with cash, you need this coverage. It protects your investment. Now that protects your car. But what about you? What about your passengers? This brings us to the second critical piece of the puzzle: personal injury protection, or PIP. This is a huge deal in Texas, and it works in a way that's different from many other states. In Texas, by law, every auto policy sold must include at least $2,500 of PIP coverage, unless you specifically sign a form to reject it in writing. Never ever reject it. Here's why PIP is so powerful. It is no-fault coverage. It doesn't care who caused the accident. If you are injured in a car wreck, PIP immediately starts paying for your medical expenses. It also covers 80% of your lost wages if you can't work because of your injuries. And it covers these things not just for you but for every passenger in your car at the time of the accident. Imagine you're in a minor fender bender. The other driver admits it was their fault. Your neck is sore, so you go to the doctor. The doctor says you need a few weeks of physical therapy. Without PIP, you'd have to pay for those visits out of your own pocket and then fight to get reimbursed by the other driver's insurance company. That process can take months, even years. They'll argue, they'll delay. They'll try to offer you a lowball settlement, all while your medical bills are piling up and going to collections. With PIP, you just give your own insurance information to the doctor. They bill your PIP coverage directly, and they get paid right away. No fighting, no waiting. It's a medical and financial first aid kit. It's designed to get you the care you need, immediately, without the stress of a legal battle. It covers doctor visits, ambulances, hospital stays, chiropractic care, and even things like hiring someone to help with household chores if you're laid up. For the small amount it adds to your premium, the peace of mind and immediate access to care it provides is invaluable. Don't let an agent talk you into rejecting it to save a few dollars. It's one of the best bargains in insurance. So, we've protected your car with collision and comprehensive. We've protected your immediate health with PIP. But now we have to talk about the single biggest threat on Texas roads. It's not drunk drivers, it's not speeders, it's not even giant potholes on I-35. It's the person driving next to you with no insurance at all. This brings us to the third, and what I believe is the most important coverage you can possibly buy in Texas: uninsured and underinsured motorist coverage, also known as UM/UIM. Let this sink in. According to the Insurance Research Council, roughly 1 out of every 8 drivers in Texas is uninsured. Look around you in traffic. For every 8 cars you see, one of them has zero insurance. If that person slams into you and puts you in the hospital, their insurance will pay you exactly nothing. You can sue them, sure. But if they can't afford a basic insurance policy, what makes you think they have $50,000 in assets to pay for your medical bills and totaled car? You can't get blood from a stone. This is not a rare freak occurrence. It happens every single day. Someone runs a red light, T-bones your car, and they have no license and no insurance. Your car is destroyed. You and your family are seriously injured. Your liability insurance, as we know, does nothing for you. Your PIP coverage helps with the first few $1,000s of medical bills, but it runs out fast in a serious accident. Your health insurance might cover some of the hospital stay, but you're still on the hook for a massive deductible and copays. And your car? Unless you have collision, you're getting nothing for it. You are left financially and physically broken by an accident that was 100% not your fault. This is the nightmare scenario that uninsured motorist coverage was designed to prevent. UM/UIM coverage steps in and takes the place of the insurance the at-fault driver should have had. It is your insurance company paying you for the damages caused by someone else. There are two parts to it. Uninsured motorist bodily injury pays for your medical bills, pain and suffering, and lost wages when you're hit by an uninsured driver. Uninsured motorist property damage pays to repair or replace your car. The underinsured part is just as important. Let's say the person who hits you does have insurance, but they only bought the bare minimum state liability of $30,000. Your medical bills alone are $100,000. Their policy pays out its max of $30,000, and that's it. You're still short $70,000. This is where your underinsured motorist coverage kicks in, covering the difference up to your own policy limits. It is a shield. It is the only thing that protects your family from the financial devastation caused by the millions of irresponsible drivers on the road. And here's the kicker. It is shockingly inexpensive. We're often talking about a few extra dollars a month to add a layer of protection that could prevent you from going bankrupt. Rejecting this coverage to save the price of a couple of tacos a month is one of the worst financial gambles a person can make. So there you have it. The three pillars of a truly protective policy. Collision and comprehensive to fix your car, personal injury protection to cover your immediate medical needs without a fight, and uninsured/underinsured motorist to shield you from the financial irresponsibility of others. Together, they form a safety net that goes far beyond just being legal. They make you whole again when disaster strikes. Now that you understand what these critical coverages are, the next question is the one that gets almost everyone into trouble. How much do you actually need? Choosing 30/60/25 liability might be the legal minimum, but is it enough to protect your house? How much PIP is adequate? What limits should you set for your uninsured motorist coverage? Picking the wrong numbers here can be just as catastrophic as having no coverage at all. Next, we're going to break down the exact dollar amounts you should be looking for, and reveal the one number on your policy that most people get dangerously wrong. So let's talk about those numbers. The numbers on your insurance declaration page that look like a secret code. 30/60/25, 50/100/50, 100/300/100. These aren't just random figures. They are the financial firewalls standing between you and total ruin. Getting them right is everything. Let's start with the absolute bare minimum you're legally required to have in Texas. That number is 30/60/25. Sounds official, right? It's the state law. But let me be crystal clear. The state minimum isn't a recommendation. It's a trap. It's the lowest possible bar you can clear to legally drive your car off the lot. And it's designed to protect other people from you, not to protect you from financial disaster. Here's what it actually means. The first number, 30, stands for $30,000. That's the maximum amount your insurance will pay for any single person's bodily injuries in an accident you cause. The second number, 60, is $60,000. That's the total maximum your insurance will pay for all bodily injuries combined in a single accident. And the last number, 25, is $25,000. That's the maximum they'll pay for all property damage you cause. Now, you might be thinking, $25,000 for property damage? That sounds like a lot. I'm not going to be crashing into a Lamborghini. And maybe you're right. But have you seen the price of a new Ford F-150? Or a Tesla with all its delicate sensors? Or even just a basic Honda CR-V? A minor rear-end collision in stop-and-go traffic on I-35 can easily cause more than $25,000 in damage to a new vehicle, especially if the airbags deploy or there's frame damage. Hit two cars in a chain reaction? You're done. Your $25,000 limit is exhausted almost instantly, and you are personally on the hook for every single dollar above that. They will sue you. They will win. And they will garnish your wages for years to pay for it. But the property damage is not even the scariest part. The truly terrifying numbers are the first two. The 30 and the 60 for bodily injury. Let me paint you a picture. Imagine you're driving home from work. You glance down at your phone for just 1 second to check a notification. In that second, the car in front of you, a minivan, stops suddenly. You slam on your brakes, but it's too late. It's not even a bad accident. A fender bender. But inside that minivan is a family of 3. A father, a mother, and a child in the back. Everyone says they're okay at the scene, just a little shaken up. But the next day, the father and mother both wake up with severe neck pain. They go to the emergency room for a checkup. That's a few $1,000s right there. The doctor diagnoses whiplash and recommends physical therapy for both of them for the next 2 months. The father is a contractor and has to miss a week of work due to the pain. That's lost income. Let's do the math. The father's medical bills between the ER visit, follow-up appointments, and physical therapy come to $20,000. His lost wages add another $5,000. Total for him, $25,000. Your policy, with its $30,000 per person limit, covers that. You breathe a sigh of relief. But then there's the mother. Her injuries are a bit worse. Her medical bills total $35,000. Your policy has a $30,000 per person limit. So your insurance company writes a check for $30,000 and says, "That's all we can do." Who pays the remaining $5,000? You do. Out of your own pocket. But wait. Gets worse. The total bodily injury claim for both of them is $25,000 plus $35,000, which equals $60,000. And what was your per accident limit? $60,000. You have maxed it out completely. What if the child in the back also had injuries? What if there was a 4th person in the van? Your insurance is done. They've paid their maximum. Every single penny beyond that, for medical bills, for lost wages, for pain and suffering, now comes directly from you. We're talking about lawsuits that can easily climb into the hundreds of thousands of dollars. They can take your savings, your investments, and even put a lien on your house. All because you had the legal amount of insurance. So what are the right numbers? What is the minimum level of coverage a responsible person should actually carry? Most financial experts and insurance professionals will tell you to start at 100/300/100. Let's break that down. $100,000 for bodily injury per person, $300,000 for bodily injury per accident, and $100,000 for property damage. Look at the difference. With a $100,000 property damage limit, you can total a brand new Escalade and still have coverage to spare. You can cause a multi-car pileup and not have to declare bankruptcy. With a $100,000 per person and $300,000 per accident bodily injury limit, you can cover the minivan scenario we just talked about without breaking a sweat. It covers serious injuries, hospital stays, and lost wages for multiple people. This isn't overkill. This is the new baseline for being a responsible adult in a world of expensive cars and even more expensive healthcare. This is the level of coverage that lets you sleep at night. But that brings us to the single most important number on your policy. The one that most people get dangerously wrong, not because they're cheap, but because they simply don't understand what it's for. And getting this wrong can be even more devastating than having low liability limits. This number is your uninsured and underinsured motorist coverage, also known as UM/UIM. Here's a terrifying fact. Roughly 1 in every 8 drivers on the road in Texas has no car insurance at all. 1 in 8. Think about that. On your commute to work today, you probably pass dozens, if not hundreds, of uninsured drivers. Now imagine this. You do everything right. You're a safe driver. You have great 100/300/100 liability coverage. You're sitting at a red light, minding your own business, and bam, you get slammed from behind by someone going 50 miles per hour because they were texting. Your car is totaled. Your back is seriously injured, and you're going to need surgery. The other driver gets out. They're apologetic. But they don't have insurance. So who pays for any of this? Who pays your hundreds of thousands of dollars in medical bills? Who pays for your lost income when you can't work for 6 months? Who buys you a new car? Your liability coverage won't. Remember, liability pays for damage you caused to others. The other driver is at fault, but they have no insurance. You can sue them, sure. But if someone can't afford a basic insurance policy, It's a safe bet they don't have $250,000 in assets sitting around for you to claim. It's called trying to get blood from a stone. You will win the lawsuit and get nothing. This is where uninsured motorist coverage saves you. It steps in and acts like the insurance the other driver should have had. It pays for your medical bills, pays for your lost wages, pays for your pain and suffering. There's also a property damage component that pays for your car repairs or replacement. Underinsured motorist coverage is similar. It kicks in when the at-fault driver has insurance, but they only have the pathetic state minimums we just talked about. Let's say their policy only has a $30,000 limit, but your medical bills are $100,000. Their insurance pays the first $30,000, and then your underinsured motorist coverage can step in to cover the remaining $70,000. This coverage is your shield. It protects you and your family from the millions of irresponsible drivers out there. And the number one mistake people make is either rejecting this coverage to save a few dollars, or carrying limits that are way too low. So here is the critical rule. Your uninsured/underinsured motorist limits should always match your bodily injury liability limits. If you have 100/300 in liability, you must have 100/300 in UM/UIM coverage. Don't protect other people more than you protect yourself. It makes no sense. Protecting your own family from an uninsured driver is just as important, if not more important, than protecting a stranger from a mistake you might make. So now you know the numbers that can save your financial life. 100/300/100 for liability, and matching that for your uninsured motorist coverage. But here's the million-dollar question. How much does this fortress of protection actually cost? You might think bumping your coverage this high will double or triple your bill. But the real answer is shocking. The difference between the dangerous minimums and the safe numbers we just discussed is often less than the price of a couple of fancy coffees a month. In the next part, we're pulling back the curtain on insurance pricing and revealing the secret discounts and strategies you can use to get maximum protection for the absolute minimum price. So how did they come up with that number in the first place? What goes on inside the insurance company's computer that spits out a quote of $200 for you, but only $90 for your neighbor with the exact same car? It feels like a mystery, a black box of secret formulas and algorithms. But it's not. It's a calculated bet. The insurance company is betting on how likely you are to cost them money. Every single thing they ask you for is a piece of a puzzle they're solving, and that puzzle is called risk. The higher your perceived risk, the higher your premium. Your job is to understand the puzzle and show them you're a safe bet. Let's start with the big, obvious pieces. First, your driving record. This is the king of all factors. Think of it like a credit score for your driving habits. Every speeding ticket, every at-fault accident, every DUI. They're all dings on your record. A recent major violation can send your rates into the stratosphere because, in their eyes, you've gone from being a predictable driver to a potential liability. Conversely, a clean record for 3 to 5 years is like gold. It screams safe bet and unlocks some of the best rates possible. Next up is the car you actually drive. Insuring a brand new F-250 King Ranch is going to cost more than insuring a 10-year-old Toyota Corolla. Why? Few reasons. The F-250 costs a fortune to repair or replace. It has more complex parts, more expensive technology. The Corolla is cheaper to fix. But it's also about statistics. What kind of cars get stolen most often? What cars are typically involved in high-speed accidents? Insurance companies have mountains of data on every make and model. That's why a sensible, 4-door sedan with top safety ratings is an insurer's dream, while a 2-door sports car is often a red flag that signals a higher risk for speeding and accidents. Then there's you. Your age, your gender, and your marital status all play a role. Now, this can feel a little unfair, but from the insurance company's perspective, it's just cold, hard data. Statistically, drivers under 25, particularly young men, are involved in far more accidents than any other group. Their lack of experience and, let's be honest, a sometimes underdeveloped sense of mortality makes them a very high risk. Rates typically start to drop significantly once you hit 25 and continue to improve into your 50s and 60s, assuming your record stays clean. And getting married? The data shows that married individuals tend to be more stable and file fewer claims, often resulting in a nice little discount. Where you live is another huge piece of the puzzle, right down to your zip code. Insuring a car in a dense, urban area of Dallas or Houston, with its heavy traffic, higher crime rates, and increased risk of fender benders, is going to be more expensive than insuring that same car in a quiet, rural town in the Texas Hill Country. They look at theft rates, vandalism, the frequency of weather-related claims like hail, and the number of accidents per capita in your specific area. You can't do much to change your zip code, but it's crucial to understand why it matters so much. And here's one that surprises a lot of people: your credit score. In Texas, insurance companies are allowed to use a credit-based insurance score to help determine your premium. What does your ability to pay your bills on time have to do with your driving? The insurance industry's data suggests a strong correlation. People with higher credit scores tend to file fewer claims. The theory is that financial responsibility often translates to overall responsibility, including behind the wheel. It's a controversial factor, but it's a powerful one. Improving your credit score can have a direct, positive impact on what you pay for car insurance. Okay, so those are the big factors that set your baseline rate. But now for the fun part, the part where you take control. We're going on a treasure hunt for discounts, and there are more out there than you think. Most people only know about one or two, but stacking multiple discounts is how you can slash your bill by 20, 30, or even 40%. The undisputed champion of all discounts is the multi-policy or bundling discount. If you have renters or homeowners insurance, get it from the same company that writes your auto policy. The discount is usually substantial, often between 10 and 25%. The insurance company loves this because it's efficient for them, and it makes you a stickier, more loyal customer. It's the easiest and biggest win you can get. If you have a young driver in your house, the good student discount is non-negotiable. If your high school or college student maintains a B average or better, you can often get a significant discount. You just need to send in a copy of their report card. It's the insurance company's way of rewarding responsible young adults, betting that a good student is also a good, less risky driver. Here's an active one: take a defensive driving course. In Texas, completing a state-approved defensive driving course can not only get a ticket dismissed, but also net you a nice discount on your insurance for up to 3 years. It's usually a few hours online, it's inexpensive, and the return on investment is fantastic. You're literally paying a small amount of money to save a larger amount of money. Think about how you use your car. With so many people working from home or having short commutes, the low mileage discount is more relevant than ever. If you drive less than the average, which is typically around 12,000 miles a year, tell your insurance company. Some companies even offer telematics programs where you plug a small device into your car, or use a smartphone app that tracks your driving habits. Things like how much you drive, what time of day, and how hard you brake. If you're a safe, low-mileage driver, this can lead to massive savings. Dig into your car's owner's manual. Does it have anti-lock brakes, airbags, an anti-theft system like an alarm or a vehicle recovery device? These are all safety and security features that reduce risk, and each one can shave a little bit more off your premium. Make a list and make sure your agent knows about every single one. Don't underestimate loyalty. Many companies offer a loyalty discount after you've been with them for a certain number of years, like 3 or 5. But here's the trick: don't let loyalty blind you. It's great to be rewarded, but you should still shop around every couple of years to make sure that loyalty discount is actually keeping your rate competitive. Here's a simple one. How do you pay your bill? If you're paying month to month, you're likely paying extra service fees. If you can afford to pay your entire 6-month or 1-year premium upfront, you'll almost always get a paid-in-full discount. It saves the company administrative costs, and they pass a little of that savings on to you. Finally, ask about affinity or occupational discounts. Are you a teacher, a nurse, an engineer, a first responder, or a member of the military? Are you part of an alumni association, a credit union, or a club like AARP? Hundreds of organizations and professions have partnerships with insurance companies that can unlock a special discount. You'll never know unless you ask. So, the strategy isn't just about finding one magic bullet. It's about a combination of things. It's about maintaining a clean record, choosing your car wisely, and then methodically stacking every single discount you qualify for. But the most powerful strategy of all is to never get complacent. Your insurance needs and your life change. Every year you should perform an insurance checkup. Did you get married? Did you change jobs and now have a shorter commute? Did your credit score go up? These are all reasons to call your agent and ask for a policy review. And when you do that checkup, you have to decide who you're going to call. You can call a captive agent who works for one company like State Farm or Allstate, or you can call an independent agent. An independent agent is your secret weapon. They don't work for the insurance company. They work for you. They represent multiple different insurance companies, and can shop your policy across the market to find the absolute best combination of coverage and price. They do the heavy lifting for you. One last powerful lever you can pull is your deductible. Remember, that's the amount you pay out of pocket before the insurance company pays a dime. If you raise your comprehensive and collision deductibles from, say, $250 to $1,000, your premium will drop, sometimes dramatically. You're taking on a little more of the initial risk yourself, and the insurance company rewards you for it. It's a personal choice based on how much of an emergency fund you have, but it's a fantastic way to manage your monthly cost. You now have the playbook, you understand how they price you, and you have a whole arsenal of discounts and strategies to fight back and lower your bill. You are in control. But getting the perfect policy at the perfect price is only half the battle. What happens when the worst actually happens? What do you do in those chaotic, adrenaline-filled minutes after a crash? There's a right way and a very, very wrong way to handle it. In the next part, we're going to build a step-by-step accident playbook, a guide to follow from the moment of impact that could save you thousands of dollars, protect you from liability, and turn a potential nightmare into a manageable process. And that process starts the second you hear the sickening crunch of metal and glass. Your heart is pounding, adrenaline is flooding your system, and your first instinct might be to panic. Don't. This is the moment your preparation pays off. This is where the playbook begins. Step 1, the golden minute. Before you do anything else, stop. Take one deep, deliberate breath. In and out. Now run a quick internal check. Are you hurt? Wiggle your fingers and toes. Check for any sharp pain. Do the same for any passengers in your car. Ask them out loud. Are you okay? Their answer is critical. If anyone is seriously injured, unconscious, or complaining of neck or back pain, do not move them unless the car is on fire or in immediate danger. Your first and only job in that case is to call 911 and tell the dispatcher there are injuries. If everyone seems okay and the cars are drivable, the next part of this golden minute is assessing your location. Are you in the middle of a busy highway with cars flying past at 70 miles per hour? If so, and if your car can move, your priority is to get to the shoulder or the nearest safe spot. Turn on your hazard lights immediately. A minor fender bender can turn fatal if it causes a secondary, high-speed collision. Safety first, always. If the cars can't be moved, everyone who is able to should get out and move to a safe place away from traffic, like behind a guardrail. Step 2. The official record. You've secured the immediate safety of everyone involved. Now you call the police. Always call the police. I don't care if it's a tiny tap in a parking lot. I don't care if the other driver is the nicest person in the world and says, "Hey, let's just handle this between ourselves." That is a massive red flag. People's stories change. Their perceived injuries can magically appear a day later. Without a police report, it becomes your word against theirs. A nightmare scenario for any insurance claim. When you call 911, be calm and concise. State your location as precisely as possible, including cross streets or mile markers. Tell them there's been an accident, whether there are injuries, and if the vehicles are blocking traffic. That's it. Don't discuss fault. Don't give a dramatic retelling. Just the facts. The police report is the foundational document for your entire insurance claim. It's an objective, third-party account of the incident. In Texas, this will typically be a CR2, the blue form, for minor accidents, or a more detailed CR3 for accidents involving injury or significant damage. Getting this report filed is non-negotiable. Step 3. The information swap. While you wait for the police, it's time to interact with the other driver. Your mindset here is crucial. Be polite, be calm, but be a journalist. You are there to collect facts, not to make friends or enemies. There are 2 words you must surgically remove from your vocabulary at an accident scene. I'm sorry. Even if you think you might be at fault, even as a reflex to be polite, do not say it. In a legal context, I'm sorry can be interpreted as a full admission of guilt, and it can be used to destroy your claim. Instead, your first words to the other driver should be the same as to your passengers. Are you okay? Show concern for their well-being. Then pivot directly to the task at hand. Say, let's exchange our insurance and contact information. Now pull out your phone. Don't just write down their information. Take clear pictures of everything. You need photos of their driver's license, their insurance card front and back, and their license plate. This eliminates any chance of miswriting a policy number or misspelling a name. Here is your essential checklist of information to get from the other driver. Their full name, address, and phone number. Their insurance company and policy number. the make, model, and color of their vehicle, and their license plate number. Also, get the names and contact information of any passengers in their vehicle. If there are any witnesses, people who stopped and saw what happened, get their names and numbers too. A neutral witness is pure gold for an insurance adjuster. Be firm but polite. If the other driver is being difficult or refusing to provide information, do not escalate the situation. Simply wait for the police to arrive. That's their job. Step 4. Become a forensic photographer. Your smartphone is the most powerful tool you have at an accident scene. You are going to document everything. I want you to think like a crime scene investigator. Take more photos than you think you need. Start wide. Get pictures of the entire scene from multiple angles, showing the position of the cars in relation to the road, traffic signs, and any landmarks. Then move in closer. Photograph the damage to both vehicles. Get down low, get up high. Capture the specific points of impact. Take close-ups of dents, scratches, and broken parts. Take a picture of the other car's license plate with the damage visible in the same shot. This connects that specific damage to that specific vehicle. Look for skid marks on the pavement and photograph them. Document the weather and road conditions. Is it raining? Is the sun causing a glare? All of this context matters. Once you're done with photos, switch to video. Take a slow walk around the entire scene, narrating what you're seeing. For example, I'm at the intersection of Main and Elm. I was traveling northbound on Main. The other vehicle was turning left from Elm. Here is the damage to my front bumper. Here is the damage to their rear passenger door. This creates a time-stamped, uneditable record of the scene and your immediate recollection of the event, which is far more reliable than trying to remember the details days later. Step 5. Interacting with the officer. When the police arrive, let them take control. They will separate the drivers and get statements from each of you. When it's your turn, provide the facts as you know them. Refer to your photos if you need to. State what you saw, what you did, and what happened. Do not speculate on what the other driver was thinking or doing. Don't say, "He was probably texting." Instead say, "The other driver did not slow down for the stop sign." Stick to objective reality. Answer the officer's questions honestly and directly. Do not argue with the other driver in front of the officer. This is not a courtroom debate. Let the officer do their job of gathering the facts. Before they leave, make sure you get the officer's name, badge number, and the police report number. Ask them when and how you can get a copy of the report. This is another piece of critical information for your insurance company. Step 6. The first and most important call. You've been cleared to leave the scene. Your car is either drivable or it's being towed. You're safe. Who do you call? Before you call your spouse, your parents, or your boss, you call your insurance company. There should be a 24/7 claims hotline number on your insurance card or in their mobile app. Call it immediately. The reason for this urgency is twofold. First, you are contractually obligated to notify your insurer of an accident in a timely manner. Waiting days or weeks can jeopardize your claim. Second, the sooner you start the process, the sooner they can act on your behalf. They can arrange for a tow, schedule an adjuster to look at your car, and set you up with a rental if you have that coverage. When you make that call, have all the information you just gathered ready to go: your policy number, the date and time of the accident, the location, the police report number, and all the information about the other driver and their insurance. The person on the other end of the line is a trained claims professional. They will walk you through the next steps. They'll assign you a claim number. Write this down and keep it handy, as it will be your reference for everything that follows. They will likely schedule a time for an adjuster to contact you for a more detailed statement. By following these 6 steps, you have taken control of a chaotic situation. You've prioritized safety, gathered irrefutable evidence, and officially started the process of making you whole again. You've protected yourself from liability and laid a perfect, concrete foundation for a smooth and successful insurance claim. You've turned a nightmare into a checklist. Now you're ready for the claims process itself, which is a whole different journey we're about to navigate together. The first step on this journey is a phone call. Your heart is still pounding, the adrenaline is fading, and now you have to make a call that could be worth thousands or even tens of thousands of dollars. Who do you call? Do you call the friendly local agent whose face is on the billboard down the street? Or do you call the 1-800 number on the back of your insurance card? This is your first strategic decision. Calling your agent can be comforting. They know you have a relationship, and they can offer guidance and help you get the claim started. Feels personal. However, your agent is primarily in the business of selling and servicing policies. They aren't a claims adjuster. They will, in most cases, simply collect your information and pass it along to the claims department, effectively just starting the process for you. Calling the 1-800 claims number, on the other hand, puts you directly into the system. It's faster, more direct, and you're immediately speaking with someone in the department that will actually handle your case. My advice? If you're feeling overwhelmed and need a friendly voice, start with your agent. But if you feel composed and ready to get the ball rolling, call the main claims line directly. It cuts out the middleman and accelerates the process. Whichever number you dial, the person on the other end is going to ask for the facts. This is not the time for emotion, speculation, or long winding stories. Remember that folder we talked about? The one with the other driver's information, the police report number, photos, and your notes? This is its moment to shine. You will provide your name, policy number, the date, time, and location of the accident. You will provide the other driver's name and their insurance information. You will state the facts as you documented them. Crucially, you need to understand that this initial call may be recorded. So let's establish rule number 1 of the claims process. Stick to the facts. Do not apologize. Do not say, "I think I might have," or "It was probably my fault." An apology can be interpreted as an admission of guilt, even if you're just trying to be polite. You are not an accident reconstructionist. You are not a law enforcement officer. Your job is to report what happened, not to assign blame. At the end of this first call, you will be given the single most important piece of information for the next several weeks or months: your claim number. This number is the key to everything. Write it down. Put it in your phone. Tattoo it on your arm if you have to. Okay, maybe don't do that, but you get the point. Every time you call, every piece of paper you get, every email you send will reference this number. It is the social security number for your accident. Guard it. Know it. Use it. Soon after, you'll get another call or email. You've been assigned a claims adjuster. Now, we need to talk about who this person is because there's a massive misconception about their role. The claims adjuster, even from your own insurance company, is not your advocate. Let me say that again. Their job is not to get you the most money possible. Their job is to settle the claim for a fair amount, as defined by the insurance company, in accordance with your policy. They work for the insurance company. They are managing the company's financial risk. They can be friendly, helpful, and professional, and most of them are. But their ultimate loyalty is to their employer, not to you. Understanding this dynamic from the very beginning is the most powerful mindset shift you can make. It transforms you from a passive victim into an informed participant. The adjuster's first major task will be to get a recorded statement from you. They'll position it as a routine formality, just to get your side of the story. And it is routine, but it is anything but a mere formality. This is a critical evidence-gathering step for the insurance company. Everything you say can and will be used to determine fault and evaluate your claim. They may ask open-ended questions designed to get you talking, like, "So just tell me what happened in your own words." This is where you have to be disciplined. Don't ramble. Don't speculate on what the other driver was thinking. Don't guess your speed if you're not sure. It's perfectly acceptable and in fact very smart to say "I don't know" or "I don't recall." For example, if they ask, "How fast were you going?" Don't say, "Probably around 40-45. If you know you were going the speed limit of 40, say, "I was traveling at the speed limit of 40 miles per hour. If you're not certain, say, "I was traveling at a safe and legal speed with the flow of traffic." If they ask if you were injured, be careful. Adrenaline can mask pain for hours or even days. The correct answer, unless you are 100% certain you are uninjured, is, "I'm not sure yet, I'm still monitoring myself," or "I'm seeking medical advice." Never say "No, I'm fine," only to wake up the next morning with severe whiplash. You can't easily walk that statement back. The goal is to be truthful, concise, and objective. You are a narrator of facts, not a storyteller of feelings. Once the statements are collected, the next phase is assessing the physical damage to your vehicle. The adjuster will need to see the car. This typically happens in one of two ways. The first is a field inspection, where the adjuster physically comes to your home, a body shop, or the tow yard to look at the car in person. This is the traditional and often the best method. It allows them to see the full extent of the damage up close. The second and increasingly common method is a photo-based estimate. The insurance company will ask you to download an app and take a series of specific pictures of the damage. While this is faster and more convenient, it has major drawbacks. You're not a trained professional. You might miss subtle frame damage, a bent suspension component, or a small crack that indicates a much larger problem underneath the bumper. If you have the choice, always push for an in-person inspection by a qualified adjuster, or better yet, have the vehicle inspected at a reputable body shop of your choosing. After the inspection, whether in person or by photo, you will receive your first estimate. I want you to look at this document not as a final check, but as an opening offer. It's the starting point of a negotiation. In almost every single case, the insurance company's initial estimate will be low. This isn't necessarily because they're being malicious. They are writing the estimate based only on the damage they can see. They can't see the cracked radiator support that's hidden behind the bent bumper. They don't know that a specific sensor needs to be recalibrated after being jostled. They will often use aftermarket or used parts in their estimate to keep costs down. When you see this initial, often shockingly low number, do not panic. This is normal. This is part of the process. This document is the company saying, here's what we think it will cost based on what we can see right now. Your body shop will then take this estimate and they will find all the things the initial inspection missed. They will document the hidden damage, the need for original manufacturer parts, and the required labor. This is called a supplement. The process of the shop and the adjuster going back and forth on these supplemental claims is what gets you from that lowball initial offer to the actual true cost of repairing your car correctly. Your first estimate isn't the end of the story. It's just the end of the first chapter. And now you're prepared for the real work to begin. The adjuster has given you their number, and your body shop has given you theirs. The gap between those two figures is where the real fight begins. This isn't just a disagreement. It's a negotiation. And you need to understand, the insurance adjuster is not your advocate. They are not a neutral third party. They are a trained negotiator whose primary job performance is measured by how much money they save the company. They do this by closing claims as quickly and as cheaply as possible. Your body shop, on the other hand, is your ally. Their goal is to repair your vehicle to pre-accident condition using the correct parts and procedures, and to get paid fairly for doing so. Their interests and your interests are aligned. So when your shop tears down your car and finds that bent radiator support behind the bumper, or that cracked sensor bracket the initial inspection missed, they begin what's called the supplement process. They take detailed photos, write up a new estimate line by line, and submit it to the insurance company. This is round 2. And this is where the adjuster's tactics really come into play. Let's pull back the curtain on the 4 most common objections you'll face, and exactly how you and your shop can dismantle them. The first and most common tactic is the battle over parts. The adjuster will say, we only pay for aftermarket or used parts. An aftermarket part is a copy of the original, made by a third-party company. A used part, sometimes called a LKQ, or like kind and quality part, is a salvaged piece from a junkyard. The original parts made by your car's manufacturer are called OEM, or original equipment manufacturer parts. The adjuster will push hard for aftermarket or used because they are significantly cheaper. Here's your counter-argument. First, check your policy. Some policies have an OEM endorsement that guarantees original parts, especially for newer cars. If you have it, the argument is over. You win. But most standard policies don't. So, your next step is to lean on your body shop. A good shop will argue that an aftermarket part doesn't fit correctly, that the panel gaps will be uneven, that the safety and structural integrity could be compromised. They can point to manufacturer position statements that explicitly warn against using non-OEM parts in critical safety systems. In Texas, the insurer is allowed to specify non-OEM parts, but they must be of similar kind and quality. If your shop can document that the part is inferior, maybe it's a flimsy fender or a headlight that fogs up, the insurer has to pay for the better part. The key is documentation. Don't just say it's worse, prove it. The second tactic is the labor rate dispute. The adjuster will look at your shop's estimate and say, we only pay $50 an hour for labor in this area, and your shop is charging $65. They make it sound like an ironclad rule written in stone. It's not. It's a negotiating position. What they are required to pay is the prevailing competitive rate in your geographic area. So, if most reputable, certified shops in your city charge between $60 and $70 an hour, then that is the prevailing rate. An insurer can't just pick the cheapest back-alley shop's rate and claim that's the standard for everyone. Your counter here is to gather evidence. Your shop manager deals with this every single day. They know the rates. They can often provide invoices or estimates from other insurance claims showing what other companies have paid. You can even call 3 other certified collision centers in your area and ask for their door labor rate. If those rates support your shop's price, you have a rock-solid case. You present this evidence to the adjuster and state, "This is the prevailing rate for a quality, safe repair in my area, and I expect my vehicle to be restored to pre-accident condition." The third and more technical tactic is refusing to pay for necessary procedures. The adjuster will say, "We don't pay for a pre-scan and post-scan of the vehicle's computer systems." Or, "We don't pay to blend the new paint into the adjacent panels." Modern cars are rolling computers. A minor fender bender can throw off dozens of sensors for your airbags, your anti-lock brakes, and your lane keep assist. A pre-repair scan identifies these issues, and a post-repair scan ensures they're all working correctly after the work is done. It's not optional, it's a critical safety step. Blending paint isn't just for looks. It's the only way to get a perfect color match so your car doesn't look like a patchwork quilt. The counterattack for this is simple and powerful. Manufacturer repair procedures. Every single carmaker, Ford, Toyota, Honda, all of them, publishes official step-by-step instructions on how their vehicles are to be repaired. Your body shop has access to these. When the adjuster denies a procedure, your shop manager should send them the official document from the carmaker that states the procedure is required. Not recommended, required. At that point, the adjuster has 2 choices: pay for the procedure, or put in writing that they are refusing to follow the safety guidelines set by the people who built the car. They almost never choose the latter because the liability is enormous. So what happens when you've presented all your evidence, your shop has provided all the documentation, and the adjuster just digs in their heels and says no? This is the moment most people give up. But you have more power than you think. It's time to escalate. First, you use the magic words. You say, "Please put your denial in writing and cite the specific language in my policy that excludes payment for this part or procedure." This single sentence changes the entire dynamic. It forces them to move from vague objections to a concrete, legally binding justification. Often they can't find one because it doesn't exist. If they still refuse, your next step is to politely ask to speak with their supervisor or a claims manager. The first-level adjuster often has very little authority to approve costs above a certain threshold. Their manager does. A calm, well-documented appeal to a supervisor can often break the stalemate. If that fails, it's time to invoke a powerful but little-known provision in every Texas auto policy: the appraisal clause. This is your nuclear option. You inform the insurance company in writing that you are invoking the appraisal clause to resolve the dispute over the cost of repairs. Here's how it works. You hire your own independent appraiser, and the insurance company hires theirs. Those 2 appraisers then try to agree on a price. If they can't, they mutually select a third, neutral appraiser called an umpire. The umpire reviews the facts and makes a final decision. A decision agreed to by any 2 of the 3 is legally binding on both you and the insurance company. It takes the decision out of the adjuster's hands completely. It's a game changer. Now, sometimes during this back and forth, the supplement costs start to pile up. The total cost of repair starts getting dangerously close to the car's actual value. This is when the insurance company might pivot and declare your car a total loss. In Texas, a vehicle is a total loss when the cost to repair it plus its potential salvage value equals or exceeds its actual cash value, or ACV. Actual cash value is the key phrase here. It is not what you paid for the car. It is not what you owe on the loan. It is what a similar car, same make, model, year, and condition, is selling for in your local market today. And just like with repair estimates, their first ACV offer will almost certainly be low. They'll use a valuation report that cherry-picks the cheapest comparable vehicles and applies excessive deductions for mileage and condition. Your job is to fight that lowball ACV offer with the same diligence you use for the repairs. You need to become an expert on your car's value. Go to autotradercars.com and dealership websites. Find at least 5 examples of cars just like yours currently for sale within a 100-mile radius. Save screenshots of those listings. This is your ammunition. Send those comps to the adjuster and say, "Your offer is not reflective of the local market. Here is what it actually costs to replace my vehicle." You can also point out any recent major work you've had done, like new tires or a new transmission, which adds value. Don't just accept their number. Negotiate it just like you would if you were buying or selling the car yourself. You have fought the good fight. You've countered their tactics, you've escalated when you needed to, and you've forced them to pay for a proper repair or offer a fair value for your totaled car. You've won the battle for your vehicle. But the insurance company has one final trap. A hidden cost they are counting on you not knowing about. It's a loss in value that happens even if your car is repaired perfectly. It's called diminished value, and in our final part we will expose how it works and how you can claim the last dollar that is rightfully yours. So let's talk about that perfectly repaired car of yours. It looks brand new. The body shop did an incredible job. The paint is matched, the panels are aligned, and you can't even tell it was in an accident. You drive it for another year, and then you decide it's time to upgrade. You go to the dealership, proud of how well you've maintained your vehicle, ready to trade it in. The sales manager takes your keys, walks around the car, and then disappears into his office to run the numbers. He comes back with a smile, but the number he puts on the paper makes your stomach drop. It's thousands of dollars less than what Kelley Blue Book, Edmunds, and every other pricing guide said it should be worth. You're confused. You ask him, why is the offer so low? The car is in perfect condition. And that's when he says the words that every car owner dreads. Well, I see here on the vehicle history report that it was in a significant accident last year. We have to account for that. That feeling right there, that is diminished value in its rawest form. It is the real, tangible loss of market value a vehicle suffers simply because it now has an accident history. It doesn't matter if the repairs were done by the world's greatest mechanic using factory original parts. The moment that accident was reported, a permanent financial scar was attached to your car's VIN number. And when you go to sell it or trade it in, every potential buyer, every dealership, will use that history to justify paying you less. Insurance companies are betting you don't know this. They are betting you'll be so relieved to get your car back looking good that you'll close the claim and walk away, leaving thousands of your own dollars on the table. In Texas, you have the right to be made whole. Being made whole doesn't just mean getting your car repaired. It means being restored to the financial position you were in the second before the accident occurred. And if your car was worth, say, $30,000 before the crash, and it's only worth $25,000 after perfect repairs because of its new accident history, you have not been made whole. You have suffered a $5,000 loss, and that loss is called inherent diminished value. Now, here is the most important rule you need to understand, and please, burn this into your memory. In Texas, you can only make a diminished value claim against the at-fault driver's insurance policy. This is what's known as a third-party claim. You are the third party making a claim against their policy. You cannot claim diminished value against your own insurance policy if you were the one who caused the accident, or if it was a hit and run and you're using your own collision coverage. The logic is that your own policy is a contract to repair the vehicle, not to guarantee its market value. But when someone else hits you, their liability is not just to fix the damage, but to cover all the losses their negligence caused, and that includes the loss of your car's market value. So how do you do it? How do you actually get this money? You can't just call the adjuster and say, "Hey, I think my car is worth less now. Please send me $5,000. They will laugh, maybe politely, and then they will deny your claim, stating you haven't provided any proof of loss. The burden of proof is on you. You have to prove with credible evidence that your car has lost value and exactly how much value it has lost. This is where the insurance company's games begin. If they entertain your claim at all, they might try to use a ridiculous, arbitrary formula to calculate your loss. The most famous one is called Formula 17C. It's a convoluted formula used by some insurers that starts by taking 10% of the car's book value, and then reduces that amount with a series of arbitrary modifiers for damage severity and mileage. Almost without fail, this formula spits out a laughably low number that bears no resemblance to the actual market loss. It is a tool designed to pay you as little as possible. Do not accept it. Your weapon in this fight is a professional, independent appraisal. You need to hire a licensed, credentialed appraiser who specializes in diminished value. This is not your local mechanic. This is an expert who understands the auto market, who knows how to analyze the extent of the damage, the quality of the repairs, and who can produce a detailed, data-backed report that states precisely how much value your vehicle has lost. Think of this appraiser as your expert witness. Their report is your evidence. It will typically cost you a few $100s, but it is the single most important investment you can make in this process. A strong appraisal report from a reputable expert is something the insurance company cannot easily ignore. It moves your claim from a simple opinion to a documented, evidence-based demand. Once you have this report in your hands, You or your attorney will draft a formal demand letter. This letter is sent to the insurance adjuster. It will lay out the facts of the case. Their insured was at fault, your vehicle was damaged, and as a direct result of the accident, its fair market value has been diminished. You will state the amount of the diminished value as determined by your expert appraiser, and you will formally demand payment for that amount. And of course, you will attach the full appraisal report as your primary piece of evidence. Now prepare for a negotiation. It is extremely rare for an insurance company to receive a demand letter and just send you a check for the full amount, even with a strong report. The adjuster's job is to save the company money. They will likely come back with a lower counteroffer. They might try to poke holes in your appraisal, question the appraiser's methodology, or claim the market in your area doesn't support that kind of loss. This is where you stand firm. You have the expert report on your side. You can calmly and professionally defend your position, referencing the specific data and comparisons used by your appraiser. If they offer a ridiculously low amount, you reject it and reiterate your demand. The goal is to negotiate a fair settlement that truly compensates you for your loss. Many of these claims are settled in this negotiation phase. In some cases, if the insurer refuses to be reasonable, your only remaining option is to take the matter to court, but the strength of your professional appraisal is what gives you the leverage to get a fair deal long before it comes to that. And there it is, the final piece of the puzzle, the one piece that almost everyone misses. Over the course of this series, we have taken a journey together. We started with the absolute basics, the 30/60/25 liability coverage that the state of Texas requires. We demystified the confusing world of deductibles and premiums. We uncovered the critical importance of personal injury protection, or PIP, that pays for your injuries no matter who is at fault. We shined a light on the single most important coverage you can buy, uninsured and underinsured motorist protection, your shield against the millions of drivers out there with little or no insurance. We've walked through the claims process, what to do and what not to say. And now we end here with diminished value. It's the perfect end to our story because it encapsulates the entire theme of this series. Knowledge is your protection. Insurance isn't just a piece of paper you keep in your glove box. It's a complex financial tool, and the person who understands it best is the person who is best protected. The insurance company has teams of experts, adjusters, and lawyers all working to protect their bottom line. You are on the other side of that table alone, but you're not alone anymore. You now have the knowledge to level the playing field. You know what questions to ask. You know what coverages to demand. You know what tricks to look out for. You started this series as a beginner, but you are finishing it as an informed, empowered consumer, capable of protecting yourself and your family. The road is an unpredictable place. Accidents happen, but financial devastation from an accident? That is optional. That is a choice. And by investing your time to learn this, you have made the choice to be protected. So my final request to you is this. Don't let this knowledge end with you. Think of one person, a friend, a family member, your child who is just starting to drive, and share this entire series with them. The link to the full playlist is in the description. Sending them this playlist could be one of the most important financial gifts you ever give them. It could save them from a mistake that costs them their car, their savings, or even their home. Thank you for taking this journey. Drive safe, stay informed, and never forget that you are now in the driver's seat. In more ways than one.